In the world of finance, there's this one huge multi-trillion-dollar question that keeps pretty much everyone up at night, from CEOs to you and me. And for a long time, the go-to answer was this one single powerful number. It's called value at risk. So let's dive right in and figure out what that is.
So here it is, the big question. What's the absolute most you could lose on your investment? I mean, think about it. Whether you're a day trader working from your kitchen or you're running a massive bank on Wall Street, you have to grapple with this. It's like staring into the void and trying to put a number on it. And for decades, the tool everyone reached for to do just that was called VaR.
Okay, so what exactly is value at risk? Or VaR, as everyone calls it. Well, imagine you could take all the crazy, complex risks in your entire portfolio. We're talking stocks, bonds, currencies, you name it, and just boil it all down into one single, easy-to-understand number. That's the magic trick of VaR. It's designed to tell you, hey, here's the level of loss that you probably won't go past, all within a certain level of confidence. Now, this number doesn't just appear out of thin air. For VaR to mean anything at all, you absolutely need two key ingredients. Think of it like a recipe. First up, the confidence level. You have to ask yourself, how sure do I want to be? Are we talking 95% certain? Are we aiming for 99%? And you gotta know, the more certain you want to be, the bigger that potential loss number is going to get. The second ingredient is your time horizon. Are you trying to figure out your risk for just the next day? Or are you looking out over, say, the next 10 days?
All right, so we know what it needs, but how do you actually calculate the thing? Well, it turns out there are a few different ways to crunch the numbers. Some are actually pretty straightforward, while others get really complex really fast. Let's take a look at the two big ones you'll see most often. Okay, the first method is probably the one that makes the most sense right off the bat. It's called historical simulation, and it's exactly what it sounds like. You literally just look back at what happened in the past. So you take your portfolio's daily returns for, say, the last year. Then you just rank them from your very best day all the way down to your absolute worst day. Now, if you decided on a 95% confidence level, you just find the point where the worst 5% of days begin. And bam, the loss at that exact point, that's your VaR. Pretty simple, right?
All right, now for the more high-tech approach. This one's called a Monte Carlo simulation. So instead of only looking backwards at what already happened, this method uses some serious computing power to run thousands, sometimes millions, of different what-if scenarios. It's like playing out a million possible futures for your portfolio. And once you have all those potential outcomes, you can build a distribution and find your VaR from there.
Okay, everything sounds great so far, right? A simple number to quantify risk. But, and this is a huge but, this is where we hit the massive, dangerous problem with VaR. For all its simplicity, it has a giant, glaring blind spot. And it's this: value at risk does not tell you your worst possible loss. Not even close. So let's break this down, because this is really the most important thing to understand about VaR. The best way to think about it is like this. VaR is a smoke alarm. A 99% VaR is basically telling you, okay, there's a 1% chance this alarm is going to go off. But here's the problem. It tells you nothing about the size of the fire. Is it just a little smoke from some burnt toast? Or is the entire building about to collapse? VaR has no idea. It just knows the alarm went off. It's completely blind to how bad things can really get in those truly catastrophic events. So that leads us to a pretty scary question, doesn't it? If VaR is just a line in the sand, the point where the alarm starts blaring, what happens when you actually step over that line? What tool do we have that can actually tell us what we're facing out there in the storm? And that's where this next concept comes in: expected shortfall. You might also hear it called conditional VaR. And this tool was literally invented to answer the one question VaR can't. It asks something very specific. Okay, for all those terrible days when we do crash past our VaR limit, what's the average loss we should expect? It finally gives us a way to measure the pain out there in that scary tail end of the distribution. And looking at them side by side really makes it crystal clear. You see, VaR asks a simple question: what's the loss I'll likely not exceed? It just defines the boundary. But expected shortfall, it looks right past that boundary and asks the really important follow-up question. Okay, but if I do cross that line, how bad is it going to hurt on average? So one of them draws the line, and the other one tells you what's waiting for you on the other side. Okay, so this isn't just theory for a textbook. These concepts have huge real-world consequences.
So let's shift gears and see how these tools are actually put into practice and baked right into the rules that govern our entire global financial system.
So there's this really important group called the Basel Committee on Banking Supervision. Basically, they're the ones who set the global rules for banks. And a huge part of their job is to make sure banks don't get too risky and blow themselves up. So they tell banks how much emergency cash or capital they have to keep on hand. For a long time, they let banks use their own VaR models to figure this out. But to make sure everyone was playing by the same rules, they had to set some very specific standards. First up, the confidence level. They set the bar really high, 99%. What that means is they're forcing every major bank to use a pretty extreme scenario as their starting point, basically a 1 in 100-day kind of loss. And second, the time horizon. They set that at 10 trading days. That's about 2 weeks. And there's a really good reason for that. They know that when a real crisis hits, you can't just snap your fingers and sell everything. It might take a bank up to 2 weeks to actually get out of a bad position and stop the bleeding.
So, why be so specific with these rules? Well, the whole point is to make things consistent and, honestly, pretty conservative. When you force every single major bank to use the exact same 99% 10-day yardstick, then for the first time, regulators can actually compare risk apples to apples. It's all about creating a standardized defense system to try and prevent another big financial crisis.
And that kind of brings us full circle to one last, pretty unsettling thought. Look, VaR was a huge leap forward in thinking about risk. And then expected shortfall came along and patched up its most dangerous hole. But at the end of the day, every single risk model we build is really just a mirror reflecting what's already happened in the past. So it leaves you wondering, if even our best, most sophisticated tools have these known blind spots, what are the truly dangerous risks that we're not seeing? What's the next unthinkable event that no model is prepared for?